Yes, I would think it is. Now, in terms of timing, that's up to the individuals. But basically, mines are a leveraged bet on the commodities that they produce. And if you see the value of gold expressed in fiat currencies rising, so long as energy prices don't rise more quickly, that's going to be good for mines. I mean, you've got to look at the input cost side as well. And also bear in mind that most producing mines, they will be managed through this. So what that means is that they will extract lower grades while they are profitable rather than the higher grades. So the idea that you can translate immediately a higher gold price into higher profits, I think you've got to temper it a little bit and just understand the reality of it. The other thing I would say is that gold is hardly owned. It's less than 0.5% of all portfolios, if you like.
The Central Bank of the Republic of Türkiye has just set a new all-time record. As of the week ending October 17th, total reserves hit $198.44 billion, driven mainly by a surge in global gold prices, which closed the week at $4,249 per ounce. Gold holdings jumped $8.77 billion in a single week, rising from $102.4 billion to $111.17 billion. Meanwhile, foreign exchange reserves slipped slightly, down just $64 million to $87.27 billion. But while Turkey's gold accumulation makes headlines, it also highlights a deeper story unfolding across the global financial system.
Physical metal tomorrow, and if he hasn't got it, he's got to go and lease it from somewhere. The lease rates have shot up. I mean, typically they were sort of up to 30, 40%. And there's some reports of them going up to 100% and more, basically saying, there's no more left to lease. The other thing, of course, is that we see a backwardation, which by definition is when the spot price is above the futures price. And people got very excited with that being over $3 at one stage, which, of course, would prompt arbitrage. I mean, people with silver sitting in COMEX warehouses would think, okay, we'll ship some of that over and make on the arbitrage. So there've been lots of stories about that. Now, how true they are or whatever, I honestly don't know. I'm sure there's a bit of it, but it's probably exaggerated. What I would say is that the backwardation of spot over futures has actually declined now to around about $1. So it's come way, way down. It still indicates that there is a shortage. In other words, a squeeze on those who are short. Because the problem is that the vast majority of the silver in the LBMA vaults is ETF silver. And the other thing which puts additional pressure on the system is, of course, people look at silver, they see silver going up, they probably think they've missed gold, and therefore the silver is a cheap way in. So they run out and buy ETFs. ETFs have to source the metal. And I think it was last week we heard that a number of ETFs, silver ETFs in India, suspended share creation because they couldn't source the silver. And I think on that basis, I mean, really what we see is that silver is too cheap for these deteriorating monetary conditions. That is absolutely clear. It is therefore going higher. But the question is, you have to ask yourself, I mean, as the price rises, what are people going to do? Are they going to just take profits? Or are they going to say, I'm going to hang on to my silver because things are not looking so good for the fiat currencies, for the dollar, whatever. Gold is going up. Gold-silver ratio currently 84, should be below that. Why should I sell my silver? So I think it's a situation which actually, particularly through the growth of ETFs, a rising price could lead to further demand and less supply, because the supply always has been from weak holders in the paper markets. So I think I think, Jesse, this is a fascinating situation. It's what they call a Giffen good, something which reverses the normal supply and demand relationships on price.
India formally recognizes silver as bank collateral with a 10-to-1 gold-silver ratio, reshaping lending, boosting demand, and igniting a new era for silver as a global monetary metal. The new rules expand that privilege to silver jewelry and ornaments, enabling borrowers to pledge up to 10 kilograms of silver or 1 kilogram of gold as collateral for loans of up to 2.5 lakh rupees, approximately 3,000 US dollars.
Where you store your metal, and whether it's Canadian Royal Mint or whatever, is to take a view on the property rights of that country. How firm are they? Are they likely to be overturned, if you like? Now, it's an interesting point. I've had arguments with people about what happened in 1933 when, you had the executive order, and basically it wasn't a gold confiscation. People say it was a gold confiscation. No, it wasn't. It was a forced submission, if you like, of your dollars for gold at that time at $20.67 to the ounce. So, if you actually had gold, and it was the banks, basically, if you had it in the banks obeyed the government. So, you lost it. On the other hand, if you had it yourself, then you just kept quiet. But it was really when it goes in the system, and if they turn around and do something like that, then you're going to lose it. The difference today is that you have, in America, there is an official gold exchange rate at $42.22 to the ounce. Now, you have to ask yourself the question, would the Americans force the banks to take your gold and gold under in their custody and all the rest of it, and exchange it for $42.22 to the ounce when the market price is 4,100 or even more? I don't know the answer to that question. There may be a legal way in which they could do it. So what I would say is you don't store your gold in America, and you don't store it in a vault owned by an American corporation. And that can be in a vault abroad. So I'd say that. I think the Royal Canadian Mint I would be less worried about, because Canada has some very strong property laws when it comes to property rights. I feel the same in the UK. The same is true in Switzerland. I think the other thing is that there is a big difference between banks who are regulated, and they may well be, the regulator, through regulation, if you like, there may be a bit of a danger there. But I think by far the biggest danger with ETFs is that actually, when you own shares or stock in an ETF, it's credit. You do not possess the metal. You do not even have an entitlement to the metal. All you have is an obligation by the manager of the ETF to perform his duties on behalf of you as a shareholder. He's got the obligation, and you've got the credit, if you like, the other side of that obligation. But then it gets more complicated, because you don't have a direct relationship, usually, with the manager of an ETF. The manager of the ETF sees as his shareholder either the DTCC or Euroclear, one of those big things. And then it's Euroclear or the DTCC which has the obligation to you. Now, what this means is that in a financial meltdown, when the DTCC or Euroclear or something similar is, if you like, in the middle of failing counterparties, they are perfectly entitled by law to take what you think is yours, shares in an ETF, and deploy it as collateral, or even dispose of them bearing in mind that it's still got the obligation to you, because it'll just say, oh, don't worry, we've got an obligation to provide it, but meanwhile we're using them, thank you very much. Are you going to be like, do you like that? No, I don't think you would. So bear these things in mind. This is the difference between owning ETFs and actually owning the physical metal, either in your possession or in the possession of, or being stored in a vault, clearly your property, in a jurisdiction with strong property rights.